This is a comprehensive problem for converting financial statements from US GAAP to IFRS. So the example posted in Moodle that I took this from, it talks about, it gives you the financial statements, and then we're going to run through a bunch of adjustments that you would need to make to take the US GAAP and convert them to IFRS. So these are actually in thousands. So in 2012, this company, JCL, had development costs of $2,000. Inventory was valued in LIFO and would be reserved adjusted for FIFO would be beginning $5,000, ending $7,000. They had plant, property, and equipment of 70. These are in thousands, so 78,571,000. That's an increase of 8,571,000. They had U.S. GAAP depreciation of 12 million. They had amortization of 1,200,000. Goodwill impairment 2 million. Goodwill actual increase in value 6 million. Available for sale securities were 15 million at the beginning of the year and 20 million at the end of the year. They had a currency gain of 2.8 million. They had a hurricane loss of 4 million. There was a long-term contingency of 3 million. They had patent infringements of 10 million. They had bonds with proceeds of 50 million with a coupon rate of 6% and market rate of 8%. They had a lease that was a 3-year lease with annual payments of 2.5 million. Market value of that was 7.5 million. The incremental borrowing rate would be assumed at 8%, and the company's effective tax rate is 25%. So you can take a minute and review the U.S. financial statements, and also make sure you read through the article prior to watching this video. So I'm going to walk you through the actual adjustments. So the very first adjustment is the fact that they had development costs of 2 million. So in this example, the development costs of 2 million under US GAAP, they would be expensing those development costs. But you can capitalize certain development costs under IFRS. In accordance with IAS 38, intangible assets, it has to meet 6 criteria in order for it to be capitalized. But this problem, after reading through it, does meet that 6 criteria. So 2 million of this development cost can be capitalized. So the adjustment would be development cost, which would be an asset, 2 million. Development expense, we're going to reduce expenses, $2 million. So I'm going to take you to the financial statements. I started with GAAP, and then I made adjustment columns. So the very first thing is we're going to actually add an asset here, and it's called development costs. And we're going to debit that adjustment, 2 million. And we're going to credit development expenses, which is part of SG&A, selling, general, and admin expenses on the income statement, and so we're going to subtract the $2 million from there. The next adjustment is that we will need to amortize that over its useful life. So this is $200,000 of amortization, and we'll have to add to expense and add to accumulated amortization. So I'm going to go right to the problem, and this is where we subtract the accumulated depreciation. Amortization, and I'm going to go right back up here to the development costs, and we subtract out $200,000 for 1.8 million. Following along, if you read the problem for adjustments 3 through 5, you cannot use FIFO. You cannot use LIFO, I'm sorry, under IFRS. So IAS number 2 says that you must use FIFO or weighted average. So we're going to use FIFO. So we need to make an inventory adjustment of $2,000. So we're going to increase inventory and decrease cost of goods sold. So I'm going to bring you over here to our financial statements. I'm going to find the asset of inventory, and I made more than one adjustment. So this first one, adjustment number 3, is $2 million. And I'm going to go right down to cost of goods sold. I made more than one adjustment. We are going to subtract out cost of goods sold, $2 million. The next adjustment is that taking away this expense results in more income tax. So we're going to increase the income tax expense and increase deferred income tax payable. So income tax expense, we're going to increase by 500,000, and I'm going to go over to the liabilities side of the balance sheet, and deferred tax liability, we are going to increase by 500. Following along with that, we also have to retrospectively state the change for the inventory as if FIFO was used the whole time. So that's what adjustment number 5 does. Inventory increased by 5 million. We're going to have deferred tax payable, and the adjustment is going to go to retained earnings directly because this is prior year cost of goods sold adjustments. So we're going to go right to the financial statements and increase inventory 5 million. We're going to increase deferred tax liability 1250. And we are going to adjust retained earnings. So I have a whole sheet, if you scroll to the bottom, about adjusting retained earnings. So this is the adjustment to retained earnings. I'll walk you through the effects on retained earnings later. So moving on to adjustment IFRS number 6A, this is revaluation model. So currently under US GAAP standards, assets are carried at historical cost, which is what we bought them at, plant, property, and equipment, that is, and then we reduce it by depreciation. Well, IFRS offers another model where you would value it at fair market value and then amortize that or depreciate that over the next remaining useful life of this. So in this problem, they had gross assets of 120,000 in plant, property, and equipment. They had accumulated depreciation 120 million, 50 million. So they had net assets of $70 million. But the fair market value of the PP&E was $78,571,000. So that's a difference or an increase in fair market value from historical cost to fair market value of $8,571,000. So they can choose on IFRS to recalculate gross and accumulated depreciation. So here's my calculation. To recalculate what part of this increase, what part of this fair market value turns into gross, is you take fair market value, you divide by the net value of the asset, and then you multiply by gross PP&E. That would give you a new adjusted gross PP&E of $134,693,000. Now we must adjust accumulated depreciation as well. So we take the fair market value, we take the net asset, and then we multiply by 50 million, which is the accumulated depreciation before, and we get a new adjusted accumulated depreciation of 56,122,000. So in order to make our balance sheet come out correctly, we need to adjust plant, property, and equipment by 14,693,000. So, and then we would increase accumulated depreciation and then put this 8 million, the difference in fair market value, to other comprehensive income. So I'm going to go right up here, and I'm going to go to PP&E. It was 120 and accumulated was 50. Now we have an increase of 14,693,000 and 6,122,000 for our final net amounts, with a net of 78,571, which is fair market value. And then we will go over to the other comprehensive income. We call it revaluation surplus, and that is the 8,571,000. Moving on to adjustment number 7, when you read through the problem, this talks about the effects of currency exchange. So we're going to take it out. You can't actually state the currency exchange in other comprehensive income. You must state it in the income statement according to IFRS. So we are going to take it out of other comprehensive income and put it into currency exchange gain. So I'm going to go to the financial statements, and this is where we remove it from accumulated other comprehensive income. And I'm going to go down to the income statement, and I'm going to show you we have currency gains, $2,800, $2.8 million. Now going to IFRS Adjustment 8, you cannot report extraordinary items according to IFRS. So therefore, the hurricane loss that was reported as an extraordinary item must be removed and reported directly in the financial statements in the income statement. So the adjustment would be, we're going to increase hurricane loss, an unusual item, and we're going to remove the extraordinary loss and the tax expense. So going down to the financial statement here, we have the removal of the tax expense, the removal of the extraordinary item, which was listed after income, and we're going to put right in here the unusual loss. So there's a tax benefit to this. All right. IFRS adjustment number 9, as you read through the problem, IAS 37 says that contingency losses must be recorded if it is more than likely instead of likely. According to US GAAP, the word likely is defined as more than 70%. According to IFRS, more than likely is more than 50%. So since this contingency was more than 50%, you're going to have to recognize a contingent liability, and we're going to have a contingency loss. So contingency loss is going to go on the income statement, or the statement of comprehensive income, and we're also going to put a liability on the balance sheet. So here is our contingency loss on the income statement, and on our balance sheet we now have the adjustment to accrued expenses, which is our contingency loss right here. IFRS Adjustment 10 talks about compound financial instruments. So basically they had a bond, and the future value of this bond's payable is $50 million. But they had to sell it at a discount because coupon rate was less than market rate. So I went forward, instead of using the table that they used, and I calculated this in Excel. So we took the future value of $50 million in the bonds. To calculate payment, I took our coupon rate, multiplied it by the 15 million, or 6% by 15 million, divided by 2 because we would pay interest semi-annually. And then I took market rate, which was 8%, and divided that by 2 to calculate interest. And it says that there's 10 years till the bond matures. So we take 10 and we times it by 2 for semi-annual payments. I went forward and solved for present value. This is a function in Excel. If you had a negative number, Excel is funky, and you would have to put the negative sign right in front of present value. So the present value of this $50 million bonds liability is $43,205. So that means we US GAAP have $50 million. Realistically, the present value is $43,205. That means we're selling at a discount there was a discount of $6,795,000. The adjustment for this discount is we debit bond payable and we credit equity for a conversion feature. So I'm going to go over here, and I'm going to go to bonds payable, and I'm going to debit it for $6,795,000, and I'm also going to credit additional paid-in capital for a conversion feature. Now, this is a topic that we will cover in further detail later in the class, but this is just to get you started on IFRS lease statements, because there are big changes coming down the road. So, leases. For US GAAP, currently, as it stands, GAAP must meet, if it meets one of the 4 conditions, the lease must be capitalized. Otherwise, it's an operating lease and expensed in the income statement in the year that you pay this. So, if it is greater than 75% of the economic life. In the example given in the problem, it's a 36-month lease of a 50-month asset. 36 divided by 50, it does not meet that criteria. If transfer the title of the lease to the leasee at the end, it states specifically that we do not transfer the title. If a bargain purchase option exists, It states that it's a fair market buyout, so no. And if the present value of the required lease payments is greater than 90% of the fair market value. So it says the fair market value of the lease is $7,500,000. We make lease payments of $2.5 million. Interest rate is 8%, and it's a 3-year term. So I solve for present value in this problem, and the present value of the lease payments is $6,443,000. If we take $6 million and divide by $7.5 million, that's 86%. So it does not meet the criteria. So none of these criteria have been met. Therefore, on the US GAAP financial statements, we would have been calculating this as an operating lease, so expensing it out. ISA 17 leases says that we must, since we are using principal-based idea, and the example says that we would plan to extend our lease on this or purchase the item at the end of the lease because it's a unique item and we would do so, therefore it is likely that we would meet those criteria later, then we must capitalize now. So here's our adjustment. Leased asset, $6,443,000. And then lease obligation. So we must write on the asset and the obligation. So I'm going to go to the financial statements. And part of the obligation is current and non-current. And I'll show you how I calculated that. And we are going to write on a leased asset. Now we must also calculate depreciation expense. So this is going to go to the income statement and this is going to go to the balance sheet. So balance sheet, we're going to take out accumulated depreciation right here. And on the income statement, we are going to add to cost of goods sold for the fact that we depreciated this asset. And then we make a payment of $2,500. This is what we originally did. We pay. It doesn't affect the cash. The cash still went out. But the manufacturing expenses, we're going to reduce expenses because we already had depreciation. And we have interest expense as well. And then we reduce the lease obligation when we make a payment. I'm just going to go back to this detail. So here we have the present value of the lease payment. We subtract out the lease obligation, and I calculated this by multiplying the present value times the interest rate. So this is the percentage of the first payment that is considered towards principal, and this is interest. In year 2, the obligation is 2,143,000, and in year 3 it's 2,315,000. So therefore, in each of these, this would be current and this would be non-current. So when I go back to the lease obligation on the financial statements, I have I'm going to go back over here, and I have non-current lease obligation and current lease obligation. Now, my final thing is to run through the effects on retained earnings from these adjustments. So, we had a beginning US GAAP balance on retained earnings of $50 million. We subtracted expenses for development. We added amortization expense. Then we subtracted from cost of goods sold for the inventory adjustment. Then we added income tax. Then we adjusted for retained earnings for the retrospective inventory. Then we adjusted for a currency gain. And then we adjusted for a contingency loss, depreciation expense on our lease, and interest expense. And then we adjusted for the fact that we don't have manufacturing costs. So we would have credited retained earnings for all of these, debited retained earnings for all of these, which brings us to a final adjusted retained earnings of $56,687,000. So I went forward and put that number as our adjusted retained earnings on the balance sheet. And as you can see, our new total liabilities and equity is $266,666,000, and that is our total assets as well. So this brings us to our presentation of the financial statements. So we would list current assets, our investment, our plant, property, and equipment, our intangible assets. So we would have total assets, total liabilities. We would have the revaluation surplus here, other accumulated comprehensive income, the additional paid in capital, which is the conversion, And on our income statement, the contingency loss and the hurricane damage and the currency gain would all go before we calculate income tax. And we would come out with total comprehensive income of $28,708,000, which includes the revaluation, surplus, and the gain on financial instruments. So this problem I have posted in Moodle, this Excel file, and the article that you should read to go along with that Excel file and watch this video. And I will leave a place where you can ask any questions, but this should help you in preparation for your IFRS case that is due in week 4.